The stock market is back in the spotlight. Ever notice two different prices for the same stock? That's the bid and ask price. The bid is the highest price a buyer is willing to pay. The ask is the lowest price a seller will accept. Why does this matter? The difference between them, called the spread, is a key indicator of liquidity and a hidden cost of trading. A tight spread means the stock is actively traded, while a wide spread could signal lower interest. With market volatility on the rise and more people trading online, understanding this gap is more crucial than ever. Stay tuned, because what's happening in these price gaps could impact your portfolio more than you think. The world of Forex trading is back in the spotlight. Just this week, major currency pairs saw their spreads widen unexpectedly, from the EUR/USD to the GBP/JPY. The market's response? A wave of speculation, with traders blaming everything from central bank whispers to algorithmic trading glitches. Why does this matter? The spread, the tiny gap between a currency's buy and sell price, is how brokers make their money, but it also directly impacts a trader's profit. A wider spread can turn a winning trade into a losing one in a split second. With global economic data causing market jitters and central banks hinting at future policy shifts, this game of pips is only getting more intense. Stay tuned, because what's happening in the currency markets could hit your portfolio harder than you think. The world of Forex trading is back in the spotlight. Just this week, major currency pairs saw significant swings after unexpected economic data was released. The market's response? A surge in volatility, while traders scrambled to adjust their positions. Why does this matter? Understanding the basics, like base and quote currencies in a pair like EUR/USD, is crucial. The first currency, EUR, is the base, and the second, USD, is the quote. It's how much of the quote currency you need to buy 1 unit of the base. With global economies at a turning point, this Forex chess game is only getting more intense. Stay tuned, because what's happening in the currency markets could hit closer to home than you think. The world of Forex is back in the spotlight. Just this week, the EUR/USD, often called the fiber, saw major volatility amid shifting inflation data from both the Eurozone and the US. The response from traders? A surge in volume, with billions changing hands in minutes. Why does this matter? These moves on major pairs like the USD/JPY, the Gopher, and GBP/USD, the cable, can impact international trade, foreign investments, and even the cost of your next vacation. With central banks hinting at future interest rate changes, this high-stakes currency game is only getting more intense. Stay tuned, because what's happening in the Forex markets could hit closer to home than you think. Ever heard the term lot in trading and felt a little lost? Let's break it down. In the world of finance, a lot is a standardized quantity of an asset you can buy or sell. Think of it like buying eggs by the dozen instead of one at a time. For stocks, a standard lot is usually 100 shares. In Forex, it's 100,000 units of a currency. Why does this matter? Using lots standardizes trades, making markets more efficient and transparent for everyone, from big institutions to individual investors. Understanding lots is crucial for managing your risk and calculating potential profits or losses accurately. Stay tuned, because mastering this basic concept could be the key to smarter trading decisions. The term percentage in point is back in the spotlight. Just this week, major financial institutions have been highlighting its use in market analysis reports, from interest rate changes to stock market movements. The response? A surge in retail investors asking what this term actually means. Why does this matter? 1 percentage in point, often called a pip, represents a change of 1%. It's a way to discuss percentage changes as whole units, simplifying complex financial data. For example, a 0.5% interest rate hike can be described as a 50 basis point or half a percentage in point increase. With economic forecasts constantly shifting, understanding this financial jargon is getting more critical. Stay tuned, because what's happening in the financial markets could hit closer to home than you think. Leverage is back in the spotlight. Just this week, a record number of traders used it to amplify their positions in the volatile crypto market. What does this mean? Leverage lets you borrow capital to trade larger amounts than you own, hoping for bigger profits. Why does this matter? While it can magnify gains from small price movements, it also dramatically increases the risk of massive losses. With markets becoming more unpredictable, understanding how leverage works is more critical than ever. Stay tuned, because how this tool is used could impact your portfolio more than you think. The world of investing is back in the spotlight. Just this week, traders have been using margin accounts to amplify their market positions, from high-flying tech stocks to volatile commodities. The risk: potential margin calls, forcing investors to either add more funds or sell their holdings at a loss. Why does this matter? Widespread margin calls could trigger a domino effect, leading to market sell-offs and increased volatility that impacts even the most conservative portfolios. With market uncertainty on the rise and regulators keeping a close watch, this high-stakes strategy is only getting more intense. Stay tuned, because how traders use this leverage could hit closer to home than you think.